Right. Hello, morning all. So welcome back to Morning Cup by Aiman here. Happy Friday. Okay. So the S&P 500 run was paused on yesterday's session as disappointing earnings from the tech giants like Meta and also Microsoft triggered the sell-off. So I think this negative corporate news completely overshadowed the two major positive macro development, which is the Fed rate rate cut and also the Trump announcing a successful trade truce with China. So I think the market is now in a retracement mode where positive policy and also trade news is being ignored for uh, in favor of scrutinizing the corporate profit margin and also high AI spending. So looking at the chart, I think uptrend still intact if we were to look at the broader picture here. And if the pullback to persist, it might resort to consolidation eyeing for the 6,800 points level. Right, so if you look into next week's economic calendar for US event, so the market is now anticipating or eyeing for the most I think of it, which the inflationary data like PMI and so job data on Monday and also Wednesdays next week. Right, so for China A50 futures, well, it fell on Thursday session, as investors were underwhelmed by the outcome from the US and also China meeting, right, and the US Fed's rate decision. So I think while the US-China trade truce was announced, the market views at as a pause, a tactical pause, rather than a strategic breakout, uh, uh, lacking concrete details, which what the market wanted, right? So, I think this sell the news reaction was amplified by the Fed's hawkish rate cut, which raised concern about tighter global liquidity and also strengthening of US dollar, which I think pressure the market, right? Moving on to the WTI crude oil price, well, it traded sideways and finished flat on Thursday session as the market was caught in, I would say, in between, right? So positive demand from the again US-China trade truce was completely offset by bearish supply fears that OPEC Plus will hike production um, this weekend to fill up the gap left by Russian sanctions, right? Also, I think the US Fed's hawkish rate cut was also pressured prices by strengthening the US dollar, keeping the market in a tight consolidation range. However, following the recent rejection from the moving average, we believe that the oil still hold a bearish technical advantage, eyeing for the 57 US dollar level. Right, so looking at our local market, right? So I think the market's minor rebound yesterday was selective and occurred in a low conviction. So I think the primary driver from the US, which is the rate cut and the trade truce, right, have now concluded, provided some clarity but no strong catalyst to the major rally. So, um, you- I think we are seeing continued profit taking, not to say profit taking, but sideways consolidation, right, from the local indices after the recent run-up. So expect the market to continue trading sideways with focus on defensive stocks and also consumer staples. Uh, that shows earning resilience, right? Also, do expect a volatile market as we enter earnings season in November. Yeah. So still keep our positive trading bias intact with resistance focus at 1635 point, while support remains at firm at 1570 points. Right. So I think the the Malaysia market showed mixed performance. Sorry, yeah. So this is our heat map. So yeah, I think Malaysia market showed a mixed performance yesterday with no, I would say flattish, right? So we saw a pocket of strength in key banking and also consumer stock, but was I would say offset by weakness in some of tech and also healthcare names, right? So yeah, for I mean the key stocks in our technical watch list right now, uh, so we see a potential significant movement in these names, right? And highlighted companies, our priority focus like DM right here, for instance. So also we renewed some of the good quality names, and you may screenshot it if you want. Okay. Right. So yeah, since we talk about DM, right? Okay, so I see that the following the pullback recently, the stock might continue its bullish trajectory, eyeing for higher 7.33 ringgit, followed by 7.50 ringgit after the after the chart shows a hammer pattern, which is a reversal pattern followed by a bullish engulfing right here, and if you understand, right, this somehow tells us that the pause is over. Right, so moving on to our Malaysia trading stocks, we have Thoo today. So the stock in its pending breakout formation after testing the RM1.90 level. So with that, we expect the momentum to remain bullish and the stock able to climb further to test the next resistance at RM2 and 5 cent, followed by RM2.20 level. So if the stock to clear or to break below the support of RM1.75, so this might signals a further pullback, right? So next we have KGTS Group. So the stock is experiencing a pending breakout as well, right? So if the momentum to sustain, well, I mean, we're expecting the price to reach the RM1.57, followed by RM1.67. And do watch out for the RM1.35 support for any attempt of of reversal. Right, so yeah, for the FCPO, well, it inched higher at closing on Thursday session. I think snapping the for the losing streak, right? As traders engage in bargain hunting after the uh, price hit a 12-week low, right? So the slight recovery was supported by weaker ringgit and also a rebound in soy oil prices, right? So however, I think the markets still have a negative sentiment, and it remains intact due to the high supply forecast, I think, from the Indonesia, right? Slowing the export demand. So we still keep our negative trading bias unchanged for now, expecting the price to reach somewhere around 4,150 ringgit support level. Right, so I think that's all I have for today, and pass the floor to Aidil for his company update. Thanks, everyone.
Yep. Yep. Hi. Thanks, Aiman. Morning, everyone. Thanks for dialing in. So for me today, I have a Bursa Malaysia Berhad results note. Yesterday, they announced their 9 months results, and happy to say that the results were in line. 3Q net profit of 63.8 million ringgit was up 12% Q on Q. This was on the back of an 18% increase in the securities average daily traded value, or SADV. OPEX also came in lower Q on Q. This was really from lower staff related costs. Sorry. And so on a cumulative basis, the 9 months net profit stood at 189 million ringgit. This was down 22% year on year, but again came in within expectations. The year-on-year decline was largely due to the decline in the SADV, but again, this was more or less anticipated. In terms of SADV, the 3Q average was about 2.82 billion ringgit. This was again up 18% Q on Q. Long-awaited rebound due to factors such as improved global trade clarity and expectations of further rate cuts from the US Fed. If you recall, sometime in August, the US concluded a number of trade agreements with a number of countries, and so that helped to boost market sentiment up. And in fact, in October 2025, that sentiment has been boosted even further, and the SADV for the month is currently about 3.5 billion ringgit as at last Friday. So this is very close to the average levels in 2024, which, if you recall, was one of the best years in Bursa's history. In terms of IPOs, there were 9 in the 3Q, quite a slow quarter, relatively speaking. And this brought the total to about 41 in the 9 months. Guidance changes, Bursa lowered its PBT target slightly to about 314 to 347 million ringgit. Just slightly lower from the initial target of 369 to 408. But with that said, this new range falls just below our forecast, as we expect a stronger SADV rebound in the fourth quarter. Bursa also changed its IPO market cap guidance to 25 billion ringgit from 40 billion ringgit, as a large cap IPO has been delayed to 2026. I'm sure I don't need to say which one that is. But yeah, the number of IPOs that Bursa is looking for this year is still kept unchanged at 60. And I think looking at the pipeline, there seems to be enough meat to be able to push Bursa through to that target. Elsewhere, earlier in October, Bursa had announced that it will be paying a new annual regulatory fee, fixed fee of about 28 million ringgit per annum to the SC. And on top of this, it will also pay a new levy on derivatives revenue of about 37.5%. So combined, these two fees to the SC will be capped at 35 million ringgit for 2026 and 40 million ringgit for 2027. So this will be somewhat of a OPEX kind of item. But in mitigation, Bursa had obtained approval to raise its listing and regulatory related fees for the first time since the GFC, payable, of course, by the public listed companies. And these are expected to generate incremental revenues that are just short of the max amounts that are payable to the SC. So if you combine these two items together, the net impact is about negative 6 to 8 million ringgit, or about 1 to 2% of PBT. So not that substantial in the grand scheme of things. So post results, we make no changes to our FY25 numbers, but we do raise our FY26 SADV slightly to 3.0 billion ringgit from 2.9 billion previously. Unfortunately, the incremental revenues are eaten away by the new SC fees, so the net adjustments to our earnings are quite minimal. Our target price, though, is raised slightly to 8 ringgit 10 cents from 805, and this again follows on from our slight earnings adjustments. So, yeah, based on the recent share price strength, we think the market has somewhat priced in the recent uptick in the SADV, and so we think that our neutral call for now is still the correct call. So yeah, that's all from me. I'll pass on the floor to Aidil, the next speaker. Thanks.
Hello, hi, morning. So for Pavilion REITs has announced their results yesterday. Generally, it's within our expectation. 9 months revenue rose 6.7% year on year to 670 million, supported by full quarter contributions from Pavilion Hotel and Bayan 3 KL, which both were acquired in June 2025. Alongside continued momentum at Pavilion Bukit Jalil, which are up 14% year on year, as well as improved advertisement income from Elite Pavilion's upgraded LED screen, which is up 21% year on year. Year to date, core profit rose 15% year on year to 264 million, meeting 72% of our full year forecast. Year to date distribution per unit is 7.5 cent, which is also up 8.8% year on year, and NPI margin expanded to 62.5%. Borrowing cost has declined to 130 million in tandem with lower interest rate. So currently, Pavilion REIT holds about 76% of its total debt is on floating rates. We expect Pavilion REIT to deliver a stronger earnings next quarter in 4Q 2025 due to year-end festive spending, as well as higher variable rent collection. The REIT is also well positioned to gain from the rising tourist traffic ahead of Visit Malaysia 2026. Management remains on track to achieve mid-single-digit positive rental reversions for FY25, with stable occupancy rate across core assets. The hotel segment, while small, continues to scale quarter over quarter and now contributes 4% of the total revenue in third quarter 2025. Last quarter, they were 0.5%. Going forward, additional upside lies in Damen Mall, which is currently undergoing renovations but should possibly see a turnaround by 2026, given the master lease has already been signed with Easy Home International. Post results, we maintain our earnings forecast with an unchanged DP of RM2, 8% upside from current price. Our valuation implies a FY26 yield of 5%, offering a spread of 160 points over the current MGS 10-year yield. So that is all. Thank you all and have a great week ahead.